Assalamualaikum warahmatullahi wabarakatuh. Our group will present on chapter 13 on the subtopic of financial leverage. So, what is actually meant by financial leverage? Why it is important for us to know about this? It is a must knowledge you need to know to make sure your fund got proper finance management. Financial leverage is the use of debt to buy more assets. Leverage is employed to increase the return on equity. However, an excessive amount of financial leverage increases the risk of failure, since it becomes more difficult to repay debt. The financial leverage formula is measured as the ratio of total debt to total assets. As the proportion of debt to assets increase, so too does the amount of financial leverage. Financial leverage is favorable when the use to which debt can be put generate returns greater than the interest expense associated with the debt. Many companies use financial leverage rather than acquiring more equity capital, which could reduce the earnings per share of existing shareholders. Let's look at an example. A company used $1 million of its own cash to buy a factory, which generates $150,000 of annual profits. The company is not using financial leverage at all, since it incurred no debt to buy the factory. So, if there is no word that relates to the debt, it is not financial leverage. So, let's look at the other example. Baker company spends $100,000 of its own money and a $900,000 loan to purchase a similar factory with a $150,000 annual profit. Baker is utilizing financial leverage to generate a profit of $150,000 on a $100,000 cash investment, representing a 150% return on investment. So, there is a word that relates to debt, which is a loan. So, this is a financial leverage. The example here said that Baker's new company has a bad year and generates a loss of $300,000, which is triple the amount of its original investment. That's why this method is risky, because it had a higher risk, and remember that higher risk, higher return, but also higher loss too. Then we go through the capital structure. Capital structure is the particular combination of debt and equity used by a company to finance its overall operation and growth. Equity capital is derived from a company's own share and claims on its future cash flow and profits. Debt is represented by bond issue or loans, whereas equity is represented by common stock, preferred stock, or retained earnings. Short-term debt is also included in the capital structure. There are two types of capitalization structures. Firms can fund their operation by issuing more debt or equity. Firms that issue equity give up some ownership in the company without having to repay investors. Firms that issue debt increase their leverage by having to repay investors. For investors, the debt to equity ratio of a company is a risk indicator. Means that there are two types of capitalization, which is higher leverage and low leverage. When higher leverage means that higher debt, and low leverage means that higher equity. So the formula for degree of financial leverage is equal to the percentage change in EPS over the percentage change in EBIT multiplied by 100. Financial leverage has two effects on earnings. per share, or we call as EPS, which are the first effect and second effect, also called in different level. Thank you.
The financial leverage have two effect on earning per share, which are first effect and second effect. For the first effect, the effect can be seen in the degree of financial leverage. The degree of financial leverage is a leverage ratio that measures the sensitivity of company earnings per share to fluctuation in its operating income as a result of changes in its capital structure. This ratio indicates that the higher degree of financial leverage, the more volatile earnings will be. This is the example how to use the degree of financial leverage. For this example, the 30,000 to purchase the necessary equipment to run the business. There are three possible financial structure, which are Plan A, Plan B, and Plan C. For the Plan A, there is 0% debt. So we can see in the balance sheet, the total debt is equal to 0 since there is 0% debt from the 30,000. Then we will calculate the EPS, which is earning per share. For the formula, EPS is earning before interest and tax minus interest expenses divided by shares. So for this EPS for Plan A, 10,000 minus 0 divided by 15,000, and then we will get RM 0.67. For the Plan B, there is 20% debt at 8% interest rate. You can see in the balance sheet, the total debt is 6,000. We will get from 30,000 times 20%, and we will get 6,000. Then we will calculate the EPS for the Plan B, which is 10,000 minus 480. They will get from amount of interest 8% times 6,000 divided by 12,000 share. Then we will get 0.79. For the Plan C, 40% debt at 8% interest rate. In the balance sheet, we can see the total debt is 30,000 times 40% debt equals to 12,000. So for the EPS for Plan C is 10,000 is a earning before interest and tax minus 960 amount of interest divided by 9,000 share, which is will get RM 1 ringgit. So this is the EPS formula: earning before interest and tax minus interest divided by number of shares. From the three financial structure, in Plan A have no financial risk if the entire 30,000 is raised through the selling 15,000 shares at 2 ringgit per value. But in Plan B, finance 20% of his assets by issuing debt with 8% annual interest rate. In Plan C, 40% debt financing on the asset. Next, we will calculate the degree of financial leverage. So this is the formula of degree of financial leverage, which is EBIT divided by EBIT, earning before interest and tax, divided by EBIT minus interest expenses. So This is the calculation for the plan A, plan B, and plan C. For the plan A, the DFL, degree of financial leverage, equal to 10,000 divided by 10,000 minus 0 equals to 1. For the plan B, DFL equals to 10,000 divided by 10,000 minus 480, we will get 1.05. For the plan C, we will get 1.11. So we can see that the plan C has higher degree of financial leverage. When earning before interest and tax equals to 10,000, a 1% increase in earnings will produce 1.11% increase in earning per share, EPS, for plan C. Then they only 1.05% for plan B and 1% for plan A if no fixed cost is used to finance the business.
Now we're moving on to second effects or indifferent level. Financial leverage on the EPS concern the level of EPS at a given EBIT under a given capital structure. Need to use EBIT EPS break-even analysis or the indifferent point analysis. The table shows that the calculation of EPS under three financing options, which is common stock, debt at 8% and preferred stock at 10%, which is EPS for common stock is 2.33, for debt 8% 5.1, and for the preferred stock at 10% is 5.0. If the company want to raise 50,000 ringgit for expansion through one of the possible financing plan, which is A for all common stocks, B for all debts at 8% interest, and C for all preferred stocks at 10% dividend. The current EBIT equals to 150,000, income tax equal to 30%, number of shares outstanding equal to 20,000 units, and common stock selling price equals to 2 ringgit per share for A and B, which is for common stocks and debts at 8%. So the formula is EBIT plan A minus interest plan A times 1 minus tax minus preferred stock preferred stocks dividend plan A divided by number of stocks outstanding plan A equals to EBIT plan B minus interest plan B times 1 minus tax minus preferred stock dividend plan B divided by number of stocks outstanding plan B. So by using the information above, the calculation will be EBIT minus 0 times 1 minus 0.30, which is our tax equal to 30%, minus 0 divided by 45,000 units equals to EBIT minus 4,000 times 1 minus 0.30 minus 0 divided by 20,000 units, and we got the EBIT equals to 7,200 ringgit. Hence the EBIT EPS point, where the EPS for the two methods of financing are same at 7,200 ringgit, which is for common stock and debt at 8%. So the net profit divided by number of share outstandings, we got EPS for common stocks equals to 0.11 ringgit, and for the debt of 8% is same, is equal to 0.11 ringgit.